What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about how to invest during a recession. Here is everything you need to know. Let's go. Okay, so first of all, what is a recession? Well, the technical definition of a recession is 2 quarters of a consecutive decline in GDP. GDP stands for gross domestic product and is basically the cumulative total of all of the products and services that are created within a country over a certain time period. In this example, it is measured on a quarterly basis, and when that number declines for 2 quarters in a row, that is the technical definition of a recession. Now, how do you figure out if you're in a recession, and where do you find the chart for GDP? Well, I will link it down below, and it's basically this chart right here. It's actually very easy to see and understand. This blue line here is our GDP over time. You can see the numbers on the left-hand side here, and in 2020, we actually went through a recession. You can see this gray bar right here. This indicates the time period where we were in a recession, but since then, we've actually seen increasing GDP for every quarter since the beginning of 2020. That is when COVID hit, that is when everything crashed, and that is when GDP fell off a cliff. But since then, we have not actually had a decline in our GDP. The next quarter's numbers are about to come out in the next few weeks, but as of right now, we are not at that point. So if you're reading this and you're watching this video in April of 2022 and you see videos talking about there's a major recession and a huge crash that's about to come, well, unfortunately, we're still 3 to 6 months away from even finding out if we're in a recession. So you do have to keep that in mind when you are kind of talking about this topic. Now, what happens during a recession? What occurs in the economy during a recession, and why does it occur? Well, basically, there's a tightening. There is a freezing of capital. There is a freezing of money, and everybody gets a little bit more concerned and a little bit more worried about their capital and about their money. And because of that, companies make less sales, and because of that, people usually have less money, or they're getting laid off, or people have less jobs, or they're getting less work, and because of that, the economy struggles. The economy as a whole contracts, it slows down, and it kind of builds on the decline in GDP. It sometimes gets even worse until it gets better. Now, during this time period, what happens in the markets is that money flows out of high-risk investments. High-risk investments are startup companies, are young companies, are high-growth companies that are not profitable yet, are companies that are trying to do remarkable things and build outrageous technologies with high valuations, but haven't quite done it yet. Those are all high-risk investments, and the money, it flows out of those investments and it flows into safer investments. Companies like utility companies, like pipeline companies, like some energy companies, like consumer staples companies, like Walmart, like Target, like Trans-Canada Pipeline, like those kind of companies that are going to be here no matter what, because no matter what, you still have to pay your utility bill, or you got to pay rent, or you got to buy food at Walmart because it's the cheapest place. That's what happens during a recession. And so what we need to think about is what is going to happen in the stock market, because basically the overall picture is that companies have less money, which means people have less money, which means they can no longer afford the luxuries, and they focus on the necessities. The necessities are affordable food, so cheap food, utilities, because you have to pay that no matter what to stay warm, you have to pay the rent on wherever you live, and you have to go out and continue to buy soap and continue to buy detergent and continue to buy all these different things. Now, how do you make money in these scenarios? Well, here's 3 different kind of examples that I want to give to you. Number 1 is you buy companies that do well because they can sell at a low cost. All of the lowest cost providers are going to do extremely well because people have less money. There's going to be more demand for the low cost providers, such as Walmart, Target, and Costco. Those are the 3 that I really like. The next example of this is to buy the companies and the stocks that people have to pay no matter what. So they don't have a choice of whether or not they pay that utility bill. They don't have a choice of whether or not they get natural gas, or whether they get gasoline, or whether they pay their rent. Those are things that people have to pay for no matter what, or their cell phone bill or internet. Those are things that people don't really have a choice for, and they have to buy no matter what. So those companies are going to be safe, they're going to be steady, and they're going to be attractive in times of uncertainty. And lastly, when everything is selling off, that is the best opportunity to buy great companies, to buy long-term, fantastic companies that are oversold. So for me, every time there's a sell-off, I pick up a couple of shares of Apple, Amazon, and Google, because those are the great long-term companies that I believe in. The other option that you have is to short the market. you know that money is going to flow out of the high risk investments and into the low risk investments. It's going to go from the growth stocks to the dividend stocks. And so you have an opportunity to short the unprofitable growth stocks with high competition, the stocks that are the most likely to do poorly in tough economic situations. Those are the stocks that are going to get hit the hardest, and those represent the best opportunity to short those stocks. Now, if you're interested in learning more about this or how to short the stocks or how to get invested in these companies, definitely consider checking out my stock market fundamentals course. It is completely free when you sign up for a trial with Skillshare. The link is in the description down below. There is over 12,000 students that have gone through the course. It blows my mind to say that. There's over 400 reviews that you can take a read through, over 1.6 million minutes of watch time, and it's completely free with your trial on Skillshare. It's kind of like the Netflix of coursework, so you can take my course, you can take anybody else's course, and if you like the service, then you can keep the subscription or cancel and get everything for free. Totally up to you. The links are down below. And if you got any value out of this video, please remember to click that like and subscribe button. I sincerely appreciate it, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.